Something big is happening with NIO right now, and most people are looking at the wrong thing. Friday, the stock dropped almost 8%. Volumes spiked. Headlines screamed, sell-off. And I watched long-term investors panic over what might be the single best buying window of the year. This pullback is not the beginning of something bad. It is the calm before the storm. Let me set the stage. 2 weeks ago, NIO reported its first quarterly profit in the history of the company. Not adjusted, not pro forma, actual net income, $40 million. Revenue crushed estimates at $4.95 billion. Deliveries hit 125,000 inches Q4, up 71% year over year. HSBC upgraded to buy. Citi raised their target. The stock ran 21% in a single week. And then Friday happened. Broad market risk off, yields climbing, rate cut expectations fading. High beta names got punished across the board. NIO gave back 8% on elevated volume. That is not a NIO problem. That is a macro event hitting a stock that had just sprinted. For long-term holders, this is a gift, not a warning. Now here is why I use the word storm, and I mean it in the best possible way. NIO is coiling. There is no other way to describe it. They are stacking catalysts so quietly that the market has not even begun to price them in. Start with the product pipeline. The flagship ES9 SUV launches next quarter. 3 more models planned for 2026. Firefly just launched in Thailand and is targeting the UK, Australia, New Zealand, and over 40 markets. Q1 delivery guidance calls for 80 to 83,000 units, nearly doubling last year. That is not a company in retreat. That is a company loading the spring. But vehicles are just the surface. And this is where NIO starts to look like something the market does not have a clean comparison for. Their chip division, Shenji, just closed $330 million in outside funding at a $1.5 billion valuation. The Shenji NX9031 is a 5-nanometer autonomous driving chip. One chip matches the computing power of 4 NVIDIA Drive Orin X chips. NIO designed it. NIO owns it. And now NIO is licensing it to other automakers. They are in active talks with Leapmotor and Geely. Think about what that means. NIO is not just building cars. They are building the silicon that powers autonomous driving for an entire industry. Name another car company doing that. You cannot. The closest comparison is not Tesla. It is Apple. Apple designs its own chips, controls its own OS, owns its own ecosystem, and monetizes across hardware, software, and services. NIO is building that exact structure. SkyOS is their operating system. NAD is their autonomy subscription. BARS is their infrastructure layer. The ET9 runs all of it on their own silicon. And the battery swap network just crossed 100 million swaps. 5th-generation stations deploying this month. 1,000 new stations planned for 2026. Partnerships with Geely and FAW to open the network to other manufacturers. That is not a feature anymore. That is utility scale, subscription-based, recurring revenue infrastructure. Now here is why I say there is no real comparison. If NIO pulls this off, vehicles plus chips plus operating system plus battery infrastructure plus autonomy subscriptions plus international expansion, what category does that fit in? Auto companies trade at 0.5 to 1 times revenue. Tech platforms trade at 5 to 10 times or higher. NIO is building something in between, and the market has no multiple for it yet. That is the opportunity. Wall Street is pricing NIO like a struggling car company. The fundamentals say it is becoming a vertically integrated technology platform that happens to make cars. Now the risks. Dilution is ongoing. The CEO just received a grant of up to 248 million shares. The balance sheet still shows current liabilities exceeding current assets despite the profit. Competition from BYD and Huawei is relentless. Chip licensing is promising but unproven at scale. Eyes wide open. But here is the bottom line. NIO just proved it can be profitable. It is designing world-class silicon. It is scaling 3 brands across 40 markets. It is building battery infrastructure that other automakers want to use. And last Friday, the market gave you a discount on all of it because treasury yields ticked up. If you are thinking in years and not days, that pullback was not a red flag. It was a green light. Drop your take in the comments. Was Friday a reason to worry or a reason to add? Hit subscribe if you are in this for the long term. Next episode, we are diving into bars as infrastructure and the OEM licensing math most investors are missing. See you in the next one. The content in this video is for informational and entertainment purposes only and does not constitute financial, investment, or legal advice. I am not a licensed financial advisor. Nothing discussed here should be considered a recommendation to buy, sell, or hold any security. All investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. Always do your own research and consult a qualified financial professional before making any investment decisions.